All right, I think we can get started. Hi, everyone. My name is Lexi, and I'm with the Marketing and PR Department at QuantConnect. Thank you to everyone for joining today. Welcome if it's your first time, and welcome back if you're returning. This is our 6th monthly meetup. We hold them on the last Thursday of the month at alternating times to accommodate our friends from around the globe. The schedule for today will begin with one of our quants giving a presentation on his research into the value and momentum everywhere strategy. We hope you enjoyed the presentation, and if it sparks any research ideas or trading hypotheses, we hope you'll join us on QuantConnect.com if you're not joined already. So with that, I will let Derek take the wheel.
Hello, everyone. Thanks, Lexi. So my name is Derek Melchin. I've been a quantitative developer at QuantConnect for 10 months to the community forum directly after this presentation is done. So I recommend looking for those. I've organized this presentation to be sort of beginner friendly. There is going to be a lot of code that we're going to go through. I'll go through it as slow as I can and as clear as I can. But again, reference to the files that I upload afterwards to get a better understanding. If at any point any of these slides are confusing, feel free to unmute yourself and ask a question. But I would like to save the bulk of the discussion for after the slides are done. The slides will only take about 25 minutes to get through. So let's get started. So this is the research paper of the strategy that we're going to be looking at today. It's called Value and Momentum Everywhere. One of the authors is Clifford from AQR Capital Management. The objectives of the strategy are to capture both value and momentum anomalies. The cool thing about these two factors is in the research paper, they show that both factors have been shown to be profitable over the past, and they're both negatively correlated. So when you put them together, you get a nice smooth equity curve in theory. We're also, with this strategy, minimizing selection bias, and we're doing that by using commonly used factor measures to define these factor values. So for instance, the value factor, we're going to be using the book to market ratio, which is very commonly used in the literature. And for momentum, we're defining it as the return over the last year, excluding the most recent month, which is again a very common definition for the momentum factor. With this strategy, we're able to diversify across asset classes and also maintain a dollar neutral portfolio, so having half of our portfolio long and half short. Is there a question?
Yeah, Derek, thank you for letting me ask a question. First, should I wait or should I ask my question during this time?
If it's directly related to the slides, you can go ahead now, but we will have a large block of time after the slides to have an open discussion.
Derek, are you meaning to share a presentation?
Sorry, did I not share my screen?
Yeah, that's the first thing I was going to ask about.
Sorry,
Oh,
I meant
bad.
to jump in.
Sorry, let me just fix that here. There, how's that?
Yeah, that's better.
Perfect, okay.
And also in your presentation, will you show the mappings between momentum and the definitions that you have?
Yeah, we'll be going through that for sure. So this is the slide that I was showing just a moment ago. This is the research paper and the objectives. This is the roadmap. So I've broke this up into 4 different parts. We're going to build up the strategy incrementally. So first we'll apply the value factor to US equities. We'll then adjust it to have just the momentum factor on US equities, and then we'll combine the factors together to see how they perform. And then as a part 4, I've kind of left it as a take-home exercise. It's going to be applying both of the factor values to a collection of universes instead of just US equities. So part 1, where we're applying the value factor to the US equities, the main idea is each month, we're going to be selecting the largest, most liquid US stocks that are above $1. We then rank all of those securities by their book to market ratio, which is our value factor. I've included the formula for the book to market ratio here. It's just the book value per share divided by the market value of those shares. Once we've ranked all of our securities, we invest in all of the securities in the universe, and we're going to be longing securities with a high value factor and shorting those with a relatively low value factor. And we're doing this on a monthly basis, so we're just going to hold from the beginning of the month until the beginning of the next month. So how do we go about implementing this in QuantConnect? If we jump over to our IDE, here is kind of the high-level overview of the algorithm class. We've got our initialize method, which is where execution starts. I've removed the boilerplate code, but we're starting with adding a universe selection model, and we are creating a custom universe selection model, which I've called large liquid US equities. We'll look at the definition of that on the next slide. But on this slide, the idea is that whenever a security enters or leaves our universe, this method on securities changed is called. And what we're doing when securities come to or leave our universe is we're just creating a symbol data object and saving it into a dictionary so we can use it for later. This is the definition of the large liquid US equities class. In the initialize function at the very top, we can see that we're specifying a minimum price of $1. And we're setting month to be -1 so that we can know when the month changes, so that we can refresh our universe. The universe selection starts with the select course method. If we're in the current month, we just return the same universe that we've had, that we selected before. But if it's a new month, what we do is we select all of the securities that have fundamental data and have a price above $1. We sort all of those securities by dollar volume, and we return the top 500 based on dollar volume, so the most liquid US stocks. Once we've got those 500 securities, this select find method is called. In here, we are following the research paper, and we're restricting our securities to just common stock securities. And we're removing any ADRs, REITs, and companies in the financial services sector. Once we've removed all of those securities from our universe, we sort by market cap and return the largest 50. You can increase this universe size as you like. I just chose 50 so that we can have the algorithm complete in a reasonable amount of time. But ideally, the larger the universe with this strategy, the better, so that we can diversify across more securities. So that's the definition of our universe selection model. What we're now going to do is take a look at the definition of this symbol data class. These are the objects that we're creating for each security that's in our universe. And when it comes to the value factor, it's pretty straightforward. The symbol data class just needs to return our value factor, which again is the book to market ratio. So we're taking the inverse of the price to book ratio. That's the equivalent. We just don't have the book to market ratio in our Morningstar data. So that's the definition of symbol data. And this is kind of the overview of adding securities to the universe and removing them. So at this point, we've got our universe defined, and we've created symbol data objects for each security. Let's just switch gears for a moment to review how we go about rebalancing our portfolio. We're going to do this with tables first, and then we'll look at how it's done in the code. For the value factor, the first step is to create a table where we have the book to market ratios for each security in our universe. Once we've got that, we can then rank the value factor. And we're doing it with a positive linear ranking, so that the higher the value factor, the higher the ranking. So we can see, for example, symbol D has a value factor of 0.4, and it has the highest ranking in the table below. So if we move this table up here, we can then subtract the mean ranking, and this is what makes the portfolio dollar neutral. The idea here is to shift all the rankings so that they center around 0. We can see here that the symbol C in the above table has the middle ranking 3, and in the table below, it's changed to a 0. Now, if we move this up here, we can then remove the leverage so that our portfolio has half of, or is long, half of the portfolio is long and half of the portfolio is short. As far as the code for the rebalancing goes, here it is here. So that in our algorithm class, again at the very top, during our initialize method, we are creating a scheduled event. And this is just going to call the rebalance function at the beginning of each month. And when this method is called, we're just going to be gathering the value factors, ranking them, ranking the securities by their value factors, weighting them, making them dollar neutral. This is all stuff we saw in just on the table or in the tables before. We scale down the portfolio to stay within the leverage constraints. And at the very bottom, once we've done all of that, and we've got our portfolio weights for each symbol, we can then place the trades. It's a pretty straightforward algorithm. As far as performance go, I did actually not perform as well as it was shown in the research paper. But keep in mind that the research paper was published in 2012, and we're testing here from 2016 to the current day, so it is out of sample data. And this backtest of this chart will be included in the community forum post that is made after this presentation. So interesting note is that if you switch the way that we rank, so instead of having the positive linear relationship, so the higher the value factor, the higher the ranking, if we flip it so the higher the value of the factor, the lower the ranking, we then essentially flip the equity curve. However, we're not going to exploit this finding. We're going to maintain the definition that was made in the research paper. So we're going to stick with this component as our value factor. We'll now move on to part 2. So now we're going to be, instead of applying the value factor to US equities, we're going to be using the momentum factor. The main idea here is each month we select the same universe, the largest, most actively traded US stocks that are above $1. We then rank securities by their 12-month trailing return. That's our momentum factor. And we're just excluding the most recent month from that calculation. That's something that's done in the research paper and commonly done in other research papers as well. Again, we're going to invest in the entire universe, long securities with a high momentum factor, and shorting those with a relatively low momentum factor. Once we place our trades, we just hold until the next month. So as far as the code goes, not much changes. This is our initial algorithm class with our addition of the universe selection model and the management of the symbol data objects. The only difference here is that when a security leaves our universe, we need to dispose of the consolidators that are attached to that security. The consolidators we'll see on the next slide here. What they do is they just keep the technical indicators updated. This is the new definition of the symbol data class if we are using the momentum indicator or the momentum factor. When we initialize it, we are specifying that the momentum look back should be 12 months. And we have a delay of 1 month so that we can exclude the most recent month. We set up the consolidators and indicators. The indicators we use are rate of change and delay. And yeah, the consolidators, what they do is they just update these indicators as new data is provided for each security. After we've set up the consolidators and indicators, we then warm up the indicators by using the history method. And then at the bottom here, we can see that we have a new property called momentum, which is just returning the value of the momentum indicator. We've set up an isReady property to return if the momentum indicator is ready. And then our dispose method is at the bottom, which is just removing the consolidator when the security leaves the universe. So that's the definition of our symbol data class when using the momentum factor. When rebalancing, again, not much changes. We're just adjusting from value to momentum. So just changing that one word there. All of the rebalancing logic is the same. And here's the performance of that momentum factor portfolio. It does underperform the S&P 500 over the same backtest period, but it is profitable nonetheless. So we'll now go on to part 3. This is where we're going to be combining both of the factors, the value and momentum factor. The main idea, we select the same liquid US stocks, but now we're ranking them by 2 factors. We're ranking it by the book to market ratio and the 12-month return. And to get both of these factors into one factor that we can use, we're just going to take the mean ranking of both of those factors. Once we have that composite factor ranking, we can then invest in the entire universe once again, longing the securities with a high composite factor ranking and shorting those with a lower ranking, and holding until the next month. Our algorithm code stays mostly the same with the universe selection model and the management of the symbol data objects. We just need to change the symbol data class that we have both of the factors included inside. So we've merged the 2 symbol data classes that we've seen already. So just as we had with the momentum factor, we're setting up the consolidators and the indicators, and we're warming them up. We've got both the value property and the momentum property included here. So now that we've got 2 factors, our rebalancing logic needs to be updated to accommodate for this. Let's now review how it is done with a table, and then we'll look at the code. So here we've got a table of 5 symbols in our universe, and we've gathered their book to market ratios and their 12-month trailing return. Just as before, we rank them all with a positive linear relationship. Once we've got the ranking for each factor, we can then subtract the mean ranking of each factor. This is going to make it dollar neutral. So we're just shifting all these values to center around 0. And then we can combine the 2 columns together, taking the mean, and that is going to give us a composite factor ranking, taking into account both of those factors. And just as before, we remove leverage by dividing by the absolute sum of the entire column. So now we see half our portfolio is long, half of it is short. Now with 2 columns in this table, there's one case to note. If the original rankings are ever looking like this, where we have 1 column in increasing order and 1 column in decreasing order, then we don't actually want to hold any of those securities. So what does this look like in code? Here is our rebalancing function. It's the same as before, where we're gathering the value and momentum factor values. And then we've added our logic here to create the composite factor ranking. And that's the code that we just saw in the slides with the tables. Here's the result of combining both of the factors together. And now for part 4, the main idea is to apply the algorithm we just reviewed of using both of the factors. But instead of applying it to a single universe, we can apply the same strategy to multiple universes. And the way this works is we just apply a portion, say half of our portfolio, to one asset class or one universe, and we apply another portion to another asset class or universe. Doing this requires multiple universe selection models. And the actual implementation of doing this, again, I'll share it on the community forum after we wrap up here today. One thing to note is that the book to market ratio, which is our value factor, that isn't included for every security on QuantConnect. For example, these global equity ETFs don't have any fundamental data. When that is the case, we can replace the book to market ratio with the negative 5-year trailing return. And in the paper that I showed earlier, we're able to do this replacement because the two factors closely correlate together. So as far as next steps, what I recommend doing is taking the algorithm code that's going to be published into the research or into the community forum. You can then increase diversification by adding more securities or adding more asset classes. You can test other methods of computing the value and momentum factors. You can also test other factors as well. You can swap them in and out as you please. And another approach, which was kind of interesting, that was in the research paper, is when you're applying the strategy to multiple universes or asset classes, what you can do is, instead of applying an equal portion of the portfolio to each asset class, something that's interesting to look into is to scale the allocation of the portfolio based on the trailing volatility of each individual asset class. The research paper showed when they did it, there wasn't a huge benefit of doing so, but it's something fun to try and look into and see where it takes you. So that's all the slides I have for you today. I'll now be happy to take any questions, and we can kind of open this up to open discussion.
Derek, is it okay if I ask some questions now?
Of course.
First, I want to thank you for your presentation. It was interesting, and I appreciate especially the way that you built up, starting with the paper, and then you talked about how each of them, you followed the same pattern. And so that was more easily to follow. So thanks for that. So let me just start with the biggest picture I can, because I've done some trading, but not algorithmic trading. So the first question I have is, how did all that you did perform against the S&P? And when I say that, when someone says, how did your algorithm perform against the S&P, I'm understanding that to be that there was, I guess it's overall, it's somewhere between 8 and 10% per year is what you get in the S&P. And when someone says that, at first, is that correct? And what does that mean? I want to make sure definitions are correct here.
Yeah, that sounds about right. 8 to 10% is probably about the average return for the S&P.
So, but when someone says that, does that mean the top 30 stocks you just randomly pick, or you pick the best performing S&P, or what does it mean to say that S&P? Is it across all 500, or what's that mean?
I see. So the way I do it is I just take the Standard & Poor's index, the SPY, and then yeah, that just tracks the index itself. So you can calculate the returns just based on that index.
Okay, and the index is an average of all 500?
It's market cap weighted. So the larger the company is, the larger its proportion in the
Oh, I
index.
see. Okay,
Yeah.
but somewhere between 8 and 10%. And now comes along your algorithm based on all that was those research papers, and you said it performed better than the S&P 500. Now, how much better? And is in terms of, is this like it was 11%? Is this per annum, or when you said it performed better, what did that mean, and what percentage was that?
So sorry if I misspoke, but it actually performed worse than the S&P 500. If I just go back to the slide here, so this is the backtest when we have both the value and momentum factors. And typically the way that we compare the performance of the strategy is by using the Sharpe ratio. So I've included on the left here. This one's a little bit negative actually, because the return over the 5-year backtest is actually negative. But the S&P 500 Sharpe ratio over this period is about 0.6 or 0.7. But yeah, you can just run a quick back test on QuantConnect of buy and hold the SPY, and that will tell you the Sharpe ratio at the current time.
Okay, so as an example, you're just showing us a paper that somebody did some research, and what was the paper's return versus your return?
So the paper's return did outperform the S&P 500, but again, that was tested on data that was in the past. So that the paper was published in 2012, right? So there is some decay in the strategy once a strategy is published, because there's other traders that are using it.
I see.
Yeah.
So then it begs the question. Now, forgive me if I'm missing something, but why would I want to use that if it performed worse?
So this specific implementation, looking at this back test, you probably wouldn't want to trade this live if it hasn't performed well just over the last 5 years. But the framework that is included in this strategy of having 2 factors, you can define them however you'd like, but being able to rank securities by 2 factors, and then create a composite ranking, and then allocate your portfolio in a dollar neutral fashion that is diversified across multiple assets and asset classes. That's the beneficial part of this strategy. The actual performance of the specific implementation we have here, this underperforms the S&P 500. So you could adjust this strategy, and that's something that I invite everybody to do. For example, you could adjust, as we showed in the further research slide here. These are all ideas on how you could boost the performance of the trading strategy. But the main idea to take away from this implementation is just the framework on how everything is laid out so that you can customize it yourself and begin to research your own strategies.
So that's an interesting question to me. And if I'm taking up too much time, just tell me to stop. This is basically you introducing a framework. Now, when it comes to the world I'm used to, which is web development, there are web development frameworks. There's .NET has its own framework, and there's JavaScript frameworks like, for example, Angular or React. And is there such an analogy in the trading world?
I'm not too familiar with the frameworks you're referring to, but I mean the entire lean backtesting engine, I guess you could look at as a framework. Like that's all we're using here, right? Is just we're using the lean API and the QuantConnect data to build our algorithms. But by framework, I just mean how we've laid out the components of the strategy of having the universe selection model, and then creating our symbol data objects, which have their factor values included in them, and then having a portfolio construction rebalancing logic, which just updates the portfolio every month.
That makes perfect sense, because what you've said, the value of this is the framework. not so much the definition of momentum, right?
Exactly. Yeah. The idea that I'm trying to go for here is to kind of get you on the right path so that you can do your own research further down the line. You know,
Right.
there wouldn't be much benefit to me coming here. Oh, here's a new strategy. Run with it and start trading it. I kind of see it as it's more valuable to teach somebody how to fish and kind of, you know, give them their first fishing rod rather than giving them a bunch of fish.
Right. That makes sense to me. So the framework's there, and I go in and I define my things like momentum the way I think that they will work, and then I back test it, and that all makes sense to me. But one of the things I need to back up even further, Derek, and say, I'm asking myself if I even want to do this. Like, to me, and let me give you an example that, so Warren Buffett made a 10-year bet with some of the best market traders that just a simple, basically a simple index was very low, why can't I think of the word? The amount that you have to put in to be part of it, low something.
Low fees.
Low fees, maybe that's it. There was another word, I can't think of it. Very low fees. And he basically said, look, I'll beat your all your fancy algorithms. And he put $1 million on it. And he won. And
Hey Nick. Hey Nick. Can you hear me? Yeah, cool.
Yeah.
I just last meetup you were asking a very similar train of questions, and Derek and Colton didn't have the answers, and so I talked to the team, but Derek wasn't in that stand-up meeting, so he missed the answer. So your root question that you asked last stand-up as well, last meetup as well, was about algo trading and whether it's profitable. So it's not that simple. So firstly, all investors have different goals. So you've got to start with that. What is your goal? And so, for example, some investors are looking for short-term returns and others are looking for long-term returns. Some, for example, are measuring their investment in terms of Sharpe ratio or the risk-adjusted returns, not just the percentage benchmark. So, for example, if you've got a massive drawdown of 60%, like the S&P does, then you're exposed to a 60% loss. And who knows if that would ever recover. Versus a lot of time, algorithmic traders are looking for a better risk-adjusted return at the cost of the absolute return. So maybe they'll accept, say, 5 or 6 or 7% per year, but if that means that I'm not losing 60%, then it's a win. So it's all about what your goals are. But then, despite that, and regardless of people's goals, the absolute question of whether or not our community is making money is one that we actually measure as an internal company KPI. We measure the percentage of the absolute net profit of the community. So we want to know that our community members are profitable and that their algorithms are making money. And so we measure that and we publish it on the dashboard inside in the company. And it's about 95% of the days are profitable for the community versus the broader market, where that's about 55% of days are profitable for the broader market. So that's how we judge. That's how we judge our success. Yeah.
Well, thank you so much for sharing that. So it's so good to hear that there's a measurement of a KPI. So you said 95% of days. Is that what you said?
Yes. So that's how we're benchmarking it, is the sum of all of the community's profits every day. So it's an aggregate number. We don't know that 95% of the community members are profitable, but in aggregate, the community is net profitable.
Okay.
But just to give more space to talk more about algorithmic trading specifically, I'll be happy to answer this offline, but I don't know if it's really relevant to Derek's presentation. So maybe we could just leave it there, and if you'd like, I'm happy to answer more of those questions.
Oh, absolutely. I don't want to sound confrontational, and I completely understand that you're saying, what's your goal? If your goal is to minimize your risk, and yes, I asked it, and so yeah, making money. Yep. So yeah, I'll take it offline, and I don't know how to get a hold of you, or should I just do it in the community, or?
Yeah, I'll send through my email in the chat. Yeah, for sure. I'm very easy to reach.
Okay, thank you.
Always a pleasure.
Hi, Derek. Thanks for presenting. I just had a quick question. I may have missed it at the beginning. You said you filtered out financials. Why did you filter out financials in the universe selection?
The main reason for that is that's just what the research paper did. I just followed the universe as it was defined in the research paper.
Cool. Yeah, that's very interesting. Maybe since, like you said, once strategies are kind of published, they tend to not perform as well. It may be interesting to kind of find that maybe the strategy only works on a very specific sector and then apply it to that. Yeah, that's just food for further thought, I guess.
Yeah, that's interesting. One thing that's been changed with the universe selection in this implementation is that in the research paper, the strategy is actually applied to 90% of the total market cap. So we can take, the sum of the market cap of all of the securities and then take the largest until we're at 90%. But that universe size is just extremely large. So in this implementation, we filtered it to 500 in coarse universe selection, and then we filtered it just to 50 in fine universe selection. So you could increase the size of the universe. It just kind of slows the algorithm down a little bit. I thought 50 was kind of, it's small enough to keep the universe or the program fast, but large enough to kind of give us a good idea on how the strategy would perform. But yeah, increasing the universe would be a good direction to go if you want to diversify even larger.
Yeah, thanks.
For sure.
I have a question.
For sure.
That's okay. Thanks. I was just wondering, it's just so cool you're introducing this strategy, and I was wondering what are some other strategies out there, like just to build a framework of the various strategies, and if these strategies vary based on the computational complexity.
Yeah, so a lot of the strategies that I've created for the strategy library, they're all sourced just from research papers published online. And there's, tens to hundreds of thousands of different research papers that outline different strategies. So you can come across, many different types. For example, there's momentum, as we've seen, value, there's arbitrage, mean reversion. Some of my favorite strategies to look into is using alternative data. So for example, on QuantConnect, we have Kingo News. So you can get the news releases of specific securities, and then you can parse the news releases with natural language processing to determine if it's positive or negative sentiment, and then place your orders that way. But yeah, there's many other examples. Some big traders use weather data to kind of track different patterns that are happening throughout the world and are able to place trades that way. But yeah, I'd recommend, just kind of surfing the internet, and you'll come across many different ideas. Possibilities are endless.
Thank you so much. And since the algorithm requires ongoing refinement, is that something we have to keep up ourselves, or like personally?
What exactly do you mean by ongoing refinement?
Just continuous improvement.
Oh, okay. Yeah, I mean, you could adjust the strategy as you go, as it's live trading, but there are some drawbacks to that. You could make your adjustments to just be overfitting on the data that you've already seen. So that's a little bit dangerous. Another approach is walk forward optimization, which just does your adjustments automatically. So a simple example would be, we use the last year or the last few years, and we find out what were the best parameters for our trading strategy over the last few years. And then we apply those parameters to the following year. We trade for that year, and then we get to the very end, we do the same thing. What were the best parameters over the last few years, and apply that to the next year. So that's just a way you can do it automatically. But yeah, you definitely can change it by hand if you'd like.
Thank you so much.
You're welcome.
Also, somebody asked if you could track Reddit sentiment. Joe Bad, if you're still in here, didn't you just do a strategy on Reddit?
Yeah, I did. One of the versions is posted in the community. If you just go to the community forums and you look up Reddit, I do have a live version of it. It's basically the exact same thing, but just some minor tweaks. I just haven't had the chance to post that yet. It's been a while. But hopefully sometime this week I'll find some time to post in the community. But yeah, using alternative data is very interesting. It's kind of what I like to do. I think Derek mentioned that in the strategy library and within the documentation, there are some very great examples of using alternative data that QuantConnect does provide. But yeah, if you're looking to learn more about how to build those strategies, the way I learned was just kind of going through the community and finding strategies and playing around with them.
And Derek, looks like there is another question that asks about some good resources to learn more about algorithmic trading and strategies for a newcomer.
Sure. Well, we have a lot of educational resources directly on the QuantConnect platform. That's where I'd recommend to start. We have bootcamp lessons, which they give you instructions on how to build your algorithm, and then they actually allow you to write the code yourselves just in a step-by-step manner. We've got tons of introductory tutorials just to using Python in a financial or quantitative trading environment. That's a very useful tutorial to go through. We've got probably 50 or 60 strategy library tutorials, which just walk you through how to go about building your own strategy from scratch. The research to production tutorials are very interesting as well. It teaches you how to research your strategy in the research environment and then translate it into the backtester. So that's where I would start. And then there's tons of other resources online. Whenever I come into a problem while developing, I just throw the error in Google if I need to, and then some sort of resource usually pops up that allows you to get over the error message.
That's really exciting. So does that mean with the tools from QuantConnect, basically all of us, even me, like I could start the process?
Exactly. Anybody can start. That's our core mission, is democratize finance and allow retail investors to have access to institutional grade data and backtesting and research tools. So yeah, we have tons of resources to walk you through how to actually use our software. And we have an active community that is always sharing different strategies and helping each other fix bugs and whatnot. So yeah, we've got everything you need to get on the right foot.
Thank you.
You're welcome.
Does anybody have any other questions?
Nope, but this was very interesting.
Thanks for coming, everybody.
Wait. I've got a question.
For sure.
So you said you use many journal articles, right? What journals, provide the highest quality papers? Because what has happened in the past with me is that I've implemented quite a few papers and then they just don't work out. Like, this is an example of one of them.
Yeah,
So what journals would you recommend?
So the ones that I usually go to, I just go to ssrn.com. On there, all of the, or most of the research papers are actually free to view. I don't have any premium subscription to any individual journal itself. But yeah, my recommendation is to just look at as many different research papers as you can. But I think maybe the real benefit of using these research papers is to just walk you through how to build a strategy. I think you'll probably end up finding your best strategies just by doing your own research and coming up with your own ideas. But I think getting started with the research papers is definitely a good idea. And for that, I use ssrn.com.
Yeah, personally, research papers give you like a good idea of what is available. So for example, bearish trading, right? So if you didn't know that there's a correlation between, let's say, the Canadian dollar versus, the US dollar and wood prices, that's new information, right? And you can use that to trade.
Yeah, that's
So
a great
that's
point.
what I use it for.
That's a great point. Yeah, get your, your ideas from the research papers, but then, go and do your own research and see what works for you. That's
I was wondering if
Great.
there's still, sorry, I was wondering if there's time for another question.
yeah, of course.
Thank you. Just really excited to get started going through all the tools on QuantConnect. And I was just wondering if you might be able to outline just like any major technical backgrounds that I need to get started, or or all the tools just like will help me and I just need to get started. Or,
Yeah. So I'd say the biggest tool that you need is you need to be able to learn, or you need to be able to program in Python. And then you need to be able to know how to navigate our documentation. As soon as you've got those two skills, you can basically take the ideas from the documentation and write your own algorithm with it. But yeah, I would recommend starting with the boot camp lessons instead of just diving straight into the documentation. The boot camp lessons are a good way to get your feet going at the very beginning.
thank you so much. This
You're
is
welcome.
really exciting.
I love the excitement.
Does anybody have any last questions they would like to ask Derek or anybody else?
I've actually got a question. I'm curious if you're familiar with any trading strategies based around like relative computational complexity and entropy-based modeling for signal detection.
I'm not familiar with those concepts, no.
Okay, great. Means there might be opportunities there. Thank you.
Thank you.
I have one last question here.
Of course.
So if you have tons of data and you're looking for all kinds of correlations, just like a blind squirrel can find a nut every once in a while, you'll find correlations that aren't really genuinely, because obviously there's a difference between causation and correlation.
Mhm.
How do you weed out the correlations that are bogus?
So the idea there is to test not only on in-sample data, but reserve a portion of your data to test your model on after your model's been trained. A great example of this is to train your model. You could train your model on all of the data that you have available right now, and then you could just run the algorithm for the next 6 months, and that would be unseen data. And if the performance degrades through that out of sample period, you know that perhaps the correlations that you identified earlier don't hold going forward. Was made.
Thank you.
You're welcome.
All right, well, I think with that, we can go ahead and wrap it up for today. Thanks, Derek, for presenting with us, and to all of you for joining us. As a reminder, we hold these meetups on the last Thursday of the month. We hope to see you all again next month. To develop and deploy your strategies, please visit quantconnect.com, and to stay up to date on new events, be sure to follow us on Twitter at QuantConnect. Everybody, have a great day, and thank you guys again so much for joining us.
Thanks for coming, everybody.